record on the video. Here we go. Okay, so this is going to be Financial Accounting Chapter 9's coursework. We have 3 problems to do, 3 of the bigger ones. And once again, we're finishing up assets. Okay, hang on. Finishing up assets, a little deeper dive, a little bit anyway. And this first problem is going to help us understand a little bit about the difference between capitalizing a cost, and that means, so let me get this back over here, and I think I've got a little bit to say about it. I have troubles with this. Just a second. Nope, hang on, let me go this way. There we go. Yep. All right. So this is 9.1a. What we're going to do is we've got a bunch of different costs here. Okay, and we're going to decide which area this goes in. Okay, so does it go to a building? Does it go to machinery? What? Okay, hang on a minute, guys. I'm going to pause the recording a minute, and I'm going to go get something here. I'll be right back. I need to go to my office, so it doesn't take so long. Just a minute. I'm going to go get the key. Okay, so we're back now. We're working on Chapter 9 in Financial Accounting, the coursework. So here is the problem that we have. Okay, so you have all of these items that go into these amounts. So they want you to categorize these costs here into these types of assets. Okay, there are costs for assets. The rule of thumb is whatever the cost would be to get an asset up and running so that it works in your business, that would be the best. That would help you understand which costs go in your account. So the thing is, let me see what all they want here. They want you to, so like for A, fee paid to attorney for title search. Okay, that's going to be land. Okay, title search. See how it says title fees here? Okay, so I'm going to make, here we go. So I'm going to make an account. Okay, so land improvements, and building and other. Okay, so, all right, and we're going to put amounts in here, and we need, okay, so here is A, B, C, and so forth. Okay, so let me see if it will pick up so through S. Nope, it's not picking up the alphabet yet. Oops. Let me see if it's picking up the alphabet. No. Okay, so I got to go ahead. All right, and it would probably do it. H, I, J, K, L, M, N, O, P, P, Q, R, S. All right, 1. So how many is on here? 19. All right. Now what we're going to do is, here's something to help us. This is in the book. Something to help us. So the first one is going to be $1,200 fee paid to attorney for the title search. So the account is going to be land, and it's going to be $1,200. Okay, so $1,200 there, and I want to put land is A, $1,200. All right, so now we're just going to walk through these and try to put them in where they go the best we can. And then when we're done, we'll get some totals here. Okay, so the other column we won't use at all, but it's a place to put something that doesn't go in the other three. All right, so then the next one is B. B is cost of real estate acquired as a plant site. There's so much for land and there's so much for the building. Now, so sometimes it's kind of hard to separate land from a building, but okay, and the reason why it goes in land is that building is going to be demolished. Okay, we're going to demolish that land or that building. This building is a new building. Okay, this building is new. So let me make sure you understand why. Okay, so there's new building. So the land already had a building on it. So the cost to demolish that to get the land ready for the new building is going to go there. All right, then we have delinquent real estate taxes on the property. Well, if you buy a piece of property and when you own it, you have to bring the property tax up to date. Cost of raising and removing building acquired in B. So once again, that's going to be here. Now, proceeds from sale. So where you see the asterisks, those are amounts that are going to offset some of our costs. Okay, offset. So the costs are going out, right? Payments are going out. Receipts are coming in. So we got $500 for selling those materials from the old building. So this is going to subtract a little cost. Okay, and that's $5,000. Okay, and then F, special assessment paid to city for extension of water main to the property. So that's property. Okay, so that should be, all right, and then G. G says architects and engineers fees for plans and supervising. Well, architects are about building buildings, I guess. So we're going to go over here and put architect. And we are on 8. No, we are on G. Hold on just a second. Hold on. It's $70,000. Architects and engineers fees for plans and supervision. So this is going to be our first $70,000 that goes in under the new building. Okay, new building. Oh, hold on. Okay. Okay, $70,000. All right, premium on 1-year insurance policy during the construction. That's also going to be part of the cost of the building. Cost of filling and grading land. Okay, this is land again. So we go back over and they say 13,000. Now, money borrowed to pay building contractor. Okay, building contractor. This is money borrowed. Okay, so this is going to be your first other. This is going to be a notes payable, or I'm sorry, yeah. So we want 900,000 here, and this is going to go in as a negative. It's not a notes payable. It's cash going up, but we create a note payable for it because we have to pay it back plus interest. So that is your other. Okay, L. L is the cost of paving parking lot to be used by customers. Hang on just a second. Yep.
That's what the state says.
Okay, hang on just a second. I gotta stop my recording. Okay. Now I need to go back through. Let me put these in this here and then I'll put it in here so we don't get so confused. I left off with the money borrowed to pay the building contractor. So that was an inflow of cash, okay, and a loan that we are borrowing. And I think we'll find out more information about this further down. So the cost of repairing windstorm damage during construction. Well, when you have damage, to something, it does not go in, it usually does not go in the account. We want to put that in something different, okay? We're going to put that in something different. So if you look at this list, damage usually is not, cost to repair damage is usually not put into these accounts, okay? Once again, these accounts are more for building it up and getting it ready to use. Okay, now notice land improvements has its own spot too, but if you get damage, the cost of repairing the damage usually is not put in the capital, into the asset account. Sometimes assets are called capital, okay, raising capital, investments, okay, so larger assets that you plan to use into the future. All right, that was L. Now it's the cost of trees and shrubbery planted. Okay, that is going to be a land improvement. Okay, so that is K. Okay, so 10, oh, I missed one. Cost of paving parking lot to be used by customers. That's going to be a land improvement. Okay, cost of trees and shrubbery planted. Okay, and then cost of floodlights installed on the parking lot makes things more user friendly. Okay, and then cost of repairing vandalism. So it's kind of like the wind damage. It's going to go out over there. Okay, this next one is a income, right? Or it's coming in, not income, but an inflow, outflows and inflows. So this one is proceeds from insurance. So see, we put this vandalism here and we put this windstorm here in a different account. And then when we get the proceeds to pay for that, then that'll also reflect. So that's both of them, right? That's both of them, if my understanding is correct. So that is the proceeds of, see why we did that? If we would have put that in the asset account, then we would have had to take some back out when we got paid for it. So that has to do with our insurance. Okay, payment to building contractor for the new building. Okay, and this should be P. Proceed, nope. Okay, so let me go back. See where we're at. So M, I missed L, cost of parking lot, cost of repairing. Oh, I see. I put these on the same line. All right, let me go back. M is cost of, nope, L. What do we want? L is, here we go. Okay, we don't want, oh, hold on. I think I missed something here. J should be, okay, I'm missing something. So let me go to H. G, okay. Okay. Okay, G, actually, what is G? G is architects. Okay, A, B, C, D, E, F, G. A, oh, I see. We had that extra one. So actually, these two get added together. I apologize for that. So B has two amounts, 180,000 and 20,000. You add those together. So that's 300,000. There we go. All right, I got to go through these again. C, 12,200, 8,000. Okay, 5,000 is going to be added back because the proceeds of the salvage material, 29,000. And then architect's fee. Architect's fee goes over here. Now we're back in business. Sorry about that. We'll fix it because eventually we're going to need a total at the bottom. All right, so architect's fee is the first building cost that we're going to add to the asset account. Okay, H, premium on 1-year policy during construction. That has to do with the building. Okay, and then cost of filling and grading land back over here, I, it's 13,000. That's the last one for the land. Okay, and then we go back across. So money borrowed to pay building contractor. That's going to be our very first other. Okay, our very first other, because that's going to be something we, okay, and it's 900,000. Okay, those are the proceeds from the loan we borrowed. 900,000 goes up in cash, and we create a notes payable for however long we're supposed to do that. Cost of repairing windstorm. Remember, that is not going to be included in any asset account. The cost of paving parking lot. Now we're on L. This should be our first land improvement. Yeah, so we're looking at 33,000 for paving that. Cost of trees and shrubberies planted, and then the floodlights, then the cost of vandalism. We're not going to put that in there. But now we're going to show the proceeds from the claim that we filed for both the wind damage and the vandalism. So here comes $7,500 in insurance proceeds. Okay, we have Q, payment to building contractor for new building. Okay, so we're going to 700,000. All right, so we borrowed 900,000. We're paying 700,000 there. Okay, and then interest incurred on building loan during construction. So that's going to be included into our building account. Last one, refund of premium. Okay, refund of premium on insurance policy canceled after 11 months. So back up here for our insurance policy, we had $5,000, right? Premium on 1-year insurance. Okay, so if you take $5,000, which was up here, I'll just put this over here to the side. So $5,000 divided by 12. This is for insurance by the month. So if we cancel it a month early, we should get a refund. Okay, if we cancel it a month early. So 5,000 divided by 12 equals, right? Wait a minute. Let me see here. So refund of premium on insurance. I've got to make sure that premium is $5,000. So that's 1 year. So let's take 5,000 times or divided by 12. Okay, 4116. So it ought to be 417, I believe. Okay. Oh, no. This is the premium. Just don't make it into something that is different. So canceled after 11 months. So this is a proceed coming in. Sorry, I was trying to make it a different number. All right, so now we want a total for all of these. Okay. So let's go ahead and finish up. So 1, 2, 3, 4, 5, 6. The first 6 goes into the land account. Land. Okay. So that's through F. And then we got to fill in the amounts. Okay. So that's 1,200, 300,000, 12,200, 8,000. Now this is a negative. Okay, 29,000. Okay, that's the land. Then we jump over. We have two buildings for G and H. Okay, it's the new building. All right, so this is going to be 70,000 and 5,000. Okay, and then I is the cost of filling and grading land. That's the last land cost that was reported. Okay, and then J is other, because that's when we borrowed the money. Okay, so the proceeds from the loan are $900,000. Okay, and then K is cost of repairing windstorm damage. Yep, so this is going to be other. Cost of repairing windstorm damage, 5,000. Then the cost of paving the parking lot, that's land improvements. And then the cost of trees and floodlights, 10,000 and 3,000. They go in land improvements too. Okay, 10,000 and 3,000. Okay, and now we're on O. O is damage from vandalism. So we'll be putting that in a repair expense or something like that. We'll see what I don't think they're going to tell us exactly where that's going to go, but all right. And then we got proceeds from the insurance because we filed a claim on the 2,500 and the 5,000. Okay, so that's going to reimburse us for that to make those repairs. Okay, so by the way, this is a negative because it's a receipt. Okay, and then Q is going to be the amount we paid the building contractor. Okay, so building 700,000. And then we have another, interest, the interest that we paid for the loan. Okay, and then the last one is a reimbursement from our insurance of $600 because we only used insurance 11 months instead of 12. So they reimbursed us $600, which doesn't really make sense because they said our premium was $5,000, but we're not going to argue with it. Let's see if we're right. Okay, yes. So once again, anything that's coming in gets a negative. Okay, now I'm going to determine the debit to land. So I need a total here to get this figured out. Thank goodness for Excel. I'm going to bring it up here, enter. Now I'm just going to run it across. Okay, I'm going to run it across to see what each one is. Now we don't report this one, but we report this one, and this one. Okay, so the land, 358,400 gets a debit. The land improvements, 46,000. And the building gets $809,400. Okay, so land is used as a plant site, does lose its ability to, does not, thus, all right, remember land does not get depreciated, thus it is not depreciated. Yep. However, land improvements do lose their ability to provide services as time passes and therefore are depreciated. What would be the effect on the income statement and the balance sheet if the cost of filling and grading of land, okay, the cost of filling and grading land was omitted? Oh, no, no, oh, nope. What would be the effect on income statement and balance sheet if the cost of filling and grading land was incorrectly classified as land? So if you put that $13,000 in land instead of okay, what would be the effect on the income statement if the cost of filling and grading land was incorrectly classified as land improvements? So land improvements are depreciated over a 20-year life using the double declining balance. Well, if we were okay, so here's what they're talking about. They're talking about this cost right here. If we would have put this in land improvements, then land improvements has depreciation that goes with it. Depreciation is not going to touch these. Okay, they're not. So if it was put over here by accident, right, then that would make land improvements go up by 13,000. And then that would affect this total here. And if we're going to depreciate this, then that would be expensed. Okay, so it would, see what it says here. Depreciation expense would be overstated. Okay, if you put it in the land improvements, land would be understated and net income would be understated. No. Depreciation expense would be overstated. They're both overstated. Land improvements would be overstated and net income would be overstated. There's the one we want. Oh, it isn't either. Okay. Sorry about that. And, oh, okay. That's if this was the mistake. I'm sorry. If this was the mistake, let me make it yellow. If we put it here, then that would create, so we got that just fine. However, land improvements do. So then if this becomes part of land improvements instead of assets, land improvements get depreciated over 20 years. So the depreciation expense would be overstated because it's not supposed to be depreciated. This is where it really belongs. This is the error here, if it got put over here, and this is the correct. Remember, if it's over here, it never gets expensed. It never gets expensed. It just sits here and accumulates for the value of the land. But this one will get expensed, and it shouldn't be. So it makes depreciation expense be too much. Then land wouldn't have enough in it because it really belongs over here. And then since this gets counted against revenue, net income would be understated. Yep. So too much expense causes net income to be understated. All right. I think that takes care of that one. Let's keep moving. See if we can get through this pretty quickly. Okay, now we're ready for number 2. So remember, we have, this is comparing 3 depreciation methods. Okay, going to compare them. Remember, you can use any one you want as long as you explain in the notes of the financial statements why you are and make sure you've calculated it correctly. So this is Waylander Coatings Company purchased waterproofing equipment on January 6th. And by the way, it matters what part of the year you're buying something. Okay, what part of the year are you buying something? Because, and I don't think we talked about this too much yet, and this is 2A. All right, I may have to, oh, here's 2A. All right, we'll go down here to 2A, and then we'll do 3A. Okay. Let's go ahead and look. Purchased the waterproofing equipment on January 6th for 366,200. Put that cost in, 366,200. Does it have residual value? Yes. 30,200. Okay. $30,200 is its residual value. What is its useful life? We're looking at 4 years. Or how many operating hours? 16,800 operating hours. So you're going to have to write that stuff down. Okay. 16,800 operating hours. That's how long this piece of equipment is supposed to last. Okay. So they want straight line, units of activity, and double declining balance. So we'll do straight line first. It's usually the easiest. Okay. So, all right. Okay. And this is going to be, it's going to be 4 years. Okay, 4 years. So I'm going to have to modify this just a little bit. Okay, so year 4. Okay. All right. So let's figure the depreciation. So here's what we're going to do. We're going to take the cost, 366,200. We're going to divide by, and then subtract the residual value first. So the residual value. And then divide by a useful life of 4 years. Okay. The nice thing about straight line is it gives you the same amount of annual depreciation every year. So here's the depreciable cost. It's the cost minus the residual value. The rate, the straight line rate is 1/4. So the straight line rate is 1 divided by 4, which is 0.25. What that means is every year they're going to depreciate 25% of the piece of equipment, right? Piece of equipment. Okay, so we want, we're on 2A. We want 0.25. So, okay, let's see what we get. So all right, so then we want annual depreciation. Okay, annual depreciation. So I need to take, there's annual depreciation, but it's got to be divided by 4. Sorry about that. Divided by 4. Okay, so, and then times 4. All right, so just to be on the safe side of things, something's not right. Something's not right. So let me put this in. Okay, I've got this from another problem. It's all right. 366,200 minus 30,200. Divided by 4. Okay, that's okay. So if we take 84, okay, so here's the depreciable cost. That's all we're going to depreciate because we subtract the residual value. All right, so here's how much each year will be, right? And what is the depreciable cost? The depreciable cost is 336,000. Okay. And by the way, this should be the same across here. 36. That should be the depreciable cost. Okay, let's see if we're right. Should be right. There it is. Okay. So how do we get to this number? Depends on which depreciation method. If you use straight line, you should get 84,000. Okay, so we'll put 84,000 times 4 is 36,000. Straight line is normally your easiest depreciation. Okay, and just to test it, we're going to, yep, here it is. 84,000 times 4 does indeed equal 336,000. So we do have the first one right. Now the second one, we have 2 steps to it. Okay, we need to come up with a rate. Okay, a rate. So there's the cost minus the depreciation, and then we have to divide by the number of hours. So hang on, I'm going to type that out so you can see it. Okay. Yep. Okay. So it's going to be $20 per hour. So the units of production, here's how we got this number, equals, open parentheses, 366,200 minus the residual value, 30,200. And then we're going to divide by 4. Wait, no, divide by the number of useful hours, 16,800. I've got to make sure. Okay. Oh, we need another set of parentheses. There we go. Another set. Okay, hang on just a minute. I don't know what it's wanting. Oh, I wanted to just show you this. Okay, I just wanted to show you this is what it will be. Okay, so now let me put it in here. And then we're dividing by 16,800. So then that becomes $20. So for every hour we operate this machine using units of production. Okay, units of production is, okay, let me make this bold here to know that you're using a different method. So here is our rate. Okay, our rate is $20. So we're going to take this times 20 for every hour that we use this piece of equipment, going to be times 20. So I'm going to move that and put this in here. Oops. Okay, hang on. So we want all these numbers times $20. And this is 4 years. So the last one I did was only 3 years. Okay, so let me get this out of here. And we need hours. That's why they're giving us how many hours. So the first year we used 6,400 hours, 5,200 hours, 3,000 hours, and 2,200 hours. Now, as you can see, each year it was used less and less, but okay, so now we want times 20. So we got to take this times 20. Okay, now I'm just going to drag this across here and it should help me out. Okay, there we go. Okay, so now let's add this up. If we did this right, it should equal the depreciable cost. Okay, if we did it right. Let's see. Yes, it does. So we're just making sure that we're using the same amount each time. Okay, so there's really no difference in the total. It's the numbers that you get there. So units of activity, usually the first year you have it, you're using it as much as it'll work because it's really new. Oop, hold on. This is 100 and, yeah, oh, that's right. Okay, 104,000 is how much we're depreciating it year 2. I'm going to put another 0. Okay. And then year 3, 60,000, and then 44,000. And we've already tested it, that it adds up to 336,000. So it's good to see this difference. Now here comes double declining. Now here comes double declining. Okay, so by the way, number 3, what method yields the most depreciation over the 4 years? There's no difference. They all have the same amount of depreciation in total. It's just between the years, right? So this is going to be the same amount every year. So this is going to be an accelerated method. It's usually twice as fast as straight line. Okay, so now I'm going to use this. Residual value is not used in calculating annual depreciation. So we're going to put the book value, right? So instead of the depreciable cost, we're going to go back to the cost, 366,200. I am going to put that up here. So let me make that equal what we paid for it. Now, the double declining rate, okay, the rate was 25%, okay, but the double declining rate is going to be, so the single rate was 25%. So if we take single rate times 2, that equals 25%. Whoops. 25% times 2, that's 50%. It made this easier finally. Times 2 equals 50% depreciation because we're doubling it. Okay, this is called accelerated. Accelerated. So the double declining rate is 50%. Whoops. 50. And then we'll do it again. And then again. Okay, so it just depends on how you want. So let's do 50%. Yeah. And then let's see if we can get 50% here. Yes. And 50% here. And then we need another year yet. Okay, so let me insert a year here. Okay. So this is year 4. Okay, now let me do this. Okay, so then we're going to take 50%. So let me pull this down because it should. All right. Now let's calculate how much we have. Okay, let me see what's happening here. Annual depreciation. Okay, there's half of it. Okay, there's the depreciation. And then this one, no, this one is going to be equals this amount minus this. There's the new book value. Then the new book value is going to equal that. And then instead of 50%, we're just going to take whatever's left. Okay, we're supposed to have a depreciable amount of $336, $336,000. We're supposed to have a residual of $30,200. So we've got to put in an amount of depreciation here that when we're finished, we will get 336,000. So we want this to equal 336,000. I'm going to put that down here. Okay. So I'm going to make this equal because we want this to say 336,000. So this one is going to be the plug number. The plug number. So this is going to be equals the depreciable amount minus that one and that one and this one. Enter. So 15,000. So now we want to add these 4 together. So we've got a little check figure going on. We want to bring that down. Okay, anytime. So let's go to 73. There we go. So yes, that's it. That's it. So here are your amounts that you depreciated each year. Okay, and remember, you're only going to depreciate to the amount of the residual, right? You're only going to depreciate to where there's nothing left. So no, this should be the residual amount right here. I'll put residual amount is how much it should be. Residual amount. So you don't depreciate the residual. So now this equals the book value minus the annual depreciation, which is 30,200, and that's that residual amount. Okay, so you have to kind of watch that because it's not going to be that last year will be whatever it takes to equal the depreciable cost. All right, so we got 183,100. That's the most depreciation the first year of the three. 91,550. 45,775, and then finally the last year is going to be the last amount of depreciation. Okay, so let's add this up and see if it's correct. It is. So what method yields the highest depreciation for year one? Well, it's double declining, and it's to be very expected because it's an accelerated depreciation, kind of like this one. Kind of. You see the most depreciation in year one from the units of activity as well. But we definitely use this as accelerated because look, it's sometimes double straight line rate almost. All right, that's that one. All right, so now let's go to the next one. Let me double check my work. Uh-oh, did I miss something? Oh, yes, okay. All right, we're good. Last one. Okay, so we've got a couple of things to do here. And this is 3. Nope, this is. Oh, that last one was actually B. Sorry about that. All right, well, whatever it is, that last one was 2B. Let me go up and fix it. 2B. So much for paying attention. 2B. Actually, I made it a little easier on you because the A's usually require more work. All right. So now we're going to look at a couple of things. This is 3. Oh, this is 5B. Okay. Okay. 5B. So we're going to be using the double declining balance. Let me see if 5B is down here. There's 4A. 4A. All right. Okay, the thing that we didn't teach you was how I'm going to use this as 5B. And I'm going to make it work. Okay, 5B. Okay. One thing about all of this is that eventually you can sell fixed assets. And when you get ready to sell them, we need to know whether or not you're going to have a loss, a gain, or a wash. Okay, so you can have a gain on a sale of a fixed asset if you receive more than the book value of the asset. Okay, we'll go through that. We'll go through that. All right, let's do this. We want double declining balance. So I don't think we need this one, but we'll just go ahead and we'll take out what we don't need. All right. Following transactions, adjusting entries were completed by Robinson Company during a 3-year period. All are related to the use of delivery equipment, and they use double declining balance for depreciation. So we're going to purchase a delivery truck. Notice what time of the year it is. January 8th. Okay, so we're going to get it for $38,400. Does it have a residual life? Does it have a residual life? Well, we don't need the residual life because they're going to use double declining balance. Okay, so I don't see anything that says that. All right, so then the first time we did, here's what you have to pay attention to. Let me move this over. So this is going to show you that sometimes asset information changes and you have to change it. So let's start off. The cost, okay, was $38,400 paying cash. Okay, so let me take all this out and see if we can't make something happen here. So let me get rid of the colors until we need them. Yeah, let me take care of the colors. I don't know what we're going to need. So, okay, and then we want to take care of the amounts too. So that we don't have anything interfering with what we're working on. Okay. And okay, so here are some T accounts. Okay, we're going to get a fixed asset on January 8th. So I'm going to put 1-8, and this is year 1. Let's put 01. Okay, so that is going to come in, and it cost, now I'll go back up, it cost $38,400. Okay, $38,400. I'm not going to need straight line. Okay, I'm not going to need straight line because we're using double declining balance. So I'm going to get rid of this because I don't want it to confuse us. Okay, hang on. So that messed up a formula that I forgot I had. Just a minute. So let me go back. All right, back over here where you go. All right, so we'll make it work here. So the first thing we're going to do is get the piece of equipment. Okay, piece of equipment. And this is a truck. Okay, this is a truck. So this is a truck. Okay, truck. Okay, so there don't want, the only thing we need from straight line is how, once we know what the straight line rate is, to double it. So I'm going to put straight line rate here. Okay. So I'm going to try my best to hold on to this, even though we don't need it. And we don't know what the, all right, so then the next thing, let's just go. So we took care of buying the truck. Okay, buying the truck. So this is a truck. Okay, there's a truck. And we bought it for $38,400. Okay, so that's cash going out. Okay, so this is cash going out on 1-8-01. Okay, so down went cash for the amount we paid for the asset. Okay, that's the truck. I think I've got the truck up here. Yeah. So we may not need this fixed asset here. So we'll get rid of that. We might need other accounts. We don't know. All right. So cash went down for what we bought. Yep. So we recorded it. Now we're going to pay garage $150 for changing the oil. and replacing the oil filter and tuning the engine on the delivery truck. All right, so now we do need repairs expense. Okay, truck repairs expense, I believe is what we want. Truck repairs expense. And remember, it's going to be on the debit side. So debit. Okay, so, all right, so up goes the delivery truck. We are doing that again. 38,400 and down goes cash. 38,400. Okay, and then we're paying for those repairs. Okay, so this was putting it in the asset account. This is putting it in an expense account. This is an asset, right? The delivery truck. That's the name of it. Delivery truck. It's an asset. And here's its accumulated depreciation account that goes with it for the truck. Here's the truck repairs. So this is on 3701. So it looks like we paid $150. Okay, so we're going to record that in a truck expense account. And then down goes cash. Very good. For 3701. There we go. Okay, so now let's go ahead and record that. 150 and 150. Now it's time to do depreciation. Now it's time to do an adjusting entry for depreciation. So we got to calculate the double declining balance, but they've also given us information about, so the useful life of the truck is 8 years with a residual value of $8,100. Okay, so up here we go. The useful life is $8,100. Let's put that in right here. Okay, $8,100. No, yeah, is residual value. And this is on December 31st, 01. Its useful life then was 8 years. Okay, so we've got to come up with a double declining balance of 8 years. So the straight line rate is 1/8. 1/8. Okay, so when you take 1 and divide by 8, you get 0. Now I've got to turn that into a decimal. Okay, so we get this. Okay, this is how much the straight line rate is. It's going to get doubled. Okay, so let me get rid of this. Delete. That's fine. All right, so the straight line rate, we're going to double it. Okay, so, and I'm going to bring this here. I know I've got, this is going to be all messed up now. It's okay. It's okay. Okay, so here's the straight line rate. Now let's double it. Okay, here's the double declining, double straight line rate. Okay, so equals. So 1/8, 2/8 is 1/4, right? Yep. So we want this times 2. Okay, so we're going to get 0.25. So the double straight line rate is 1/4. Yeah. Okay, so the book value, so the straight line rate is 20%. No, the straight line rate is 25% times 2. No, 12.5 times 2. 12.5 times 2, which is 25%. So we've already determined that. So, and we'll do this as a percentage. So okay, equals point. Okay, so once again, it's this times 2, 25%. Okay, so now the double declining rate is that much. Okay, and our book value started with $38,400. Then we're going to, let me make this a little bit smaller. Then we're going to have an annual depreciation amount. And then here is the book value, the new book value, right? End of year book value. Year end book value. So that is your cost minus your depreciation. Okay, so 9,600 is the amount for the first year of double declining balance. So we're going to say $9,600 here. And we need depreciation expense of $9,600. And this is on 12/31 of 01. Okay, so I'm going to take this and copy it and bring it up here. So we know that that's going to be going in the accumulated depreciation. There it is. Okay, so here we go. Let's do the journal entry. Let me move this over a little bit. So you had to figure out what the first year of depreciation is based on double declining balance. So it's going to be depreciation for the delivery truck. We got $9,600. Let's see if we're right. Okay, it goes in accumulated depreciation as a credit and see if we're right with our entries so far. Looks like we're all right. Okay, now it's year 2. Then it says purchased a new truck for $44,100 paying cash. Okay, so another new truck. Okay, so we may want to keep that separate. But I think it all goes in delivery trucks. Yeah. Okay, we're not going to keep them separate. So it's going to go in delivery trucks, period, which I think wouldn't really happen in real life. All right. So now, what time of the year is it? It's January 9th, so pretty close to the first of the year. So we're going to put in the date. Okay. So how much did this one cost? 44,100, I think. Right? 44,100. So down goes cash. Gotta get it. Down goes cash. Well, did I forget to put the first one in? I guess I did. Down goes cash. Nope, there it is. Okay. So down it goes. $44,100. Okay, and this is on 1902. Yep. So let's see here. What do we got? Back up here. That's another truck. We want this to say 02. Okay, there it is. All right, so let's go ahead and do the new truck. So 44,100 and then cash. Okay, and now it's February 28th. Paid garage $270 to tune the engine and make other minor repairs on the used truck. So this is just truck repair again. And this is the 28th, the next year. for $270 and cash. So this is okay, there we have it. So we're going to put that in an expense account. And pay cash for it. Let's see if we're right on these last couple that we put in. So we don't want to miss anything. Okay, now we're going to get ready to sell an asset. So it says recorded depreciation. Wait, nope. Sold the truck for $25,300. So we got to record the depreciation to that date. So this is April 30th. Okay, April 30th. So let me, okay, so this is the steps for selling an asset. Steps for selling fixed asset. Okay, yep, there's steps. So the first step is update accumulation, update accumulated depreciation with regards to sales date. Okay, so we did the first year. Now we also need to do the other truck. Okay, the other truck. No, this is the sold the used truck. Okay, so we're selling the used truck. We've got to go ahead then and do the depreciation, but not for a full year. So be careful. Be careful. We're going to see if we can't pull that down. Nope. Hang on. I picked the wrong thing there. Let's go back. Okay, let's go back over here. All right, so let me just put 25% in here. Okay. All right, so then the new book value, let me bring this down. Now, this is as if it was a full year, but we are only looking at 4 months. So we really need to take the amount of the depreciation here of 7,200, right? And instead of 7,200, so I'll show you what the double declining balance would have been. So it has an 8-year life. Okay, so but we only need the second year. So I'm not going to go into all this. It's okay. Let's just take it out. We'll cut this. All right. So we need the second year amount of annual depreciation, but it's only 4 months into the year. So now we're going to take this times, that's the annual amount. So we want to take it times 4 divided by 12. I'm going to put that in here to show you a little calculation here. 4 months divided by 12 times that annual amount. So this amount, and then now we're going to take it times 4 divided by 12, right? 4 divided by 12. Okay, so that's $240 is the depreciation. So we've got to update the depreciation, right? So we're going to update it on, so we're going to make depreciation expense of $2,400. And we're going to make accumulated depreciation go up for that old delivery truck. Okay, so here is, okay, this is the selling. So this is updating used truck, second year depreciation for April. There it is. April for 4 months. 4 months. There we go. Okay, that's what that is going to be telling us. Let's see if we're right. I think we should be. Okay, check it out. Yep, we got it. Okay, So we have to update this. All right, so let's record. Let me bring this over. So we had 9,600 from the year before. Now we're going to go down here and make this just a little bit smaller. Now we're going to put 2,400 in here. Okay, 2,400, and then we're going to put year two. Year two. Okay, so we're going to add those together. And we got 12,000. Remember, that's going to go against this 3,800 for. Okay, so here's how we're going to do it. Now we're going to make the sale. You always put the amount of the proceeds at the top. Okay, maybe not. Hang on. Because it says that we got $25,300 for the amount of the cash. So, okay, I guess. So we want to debit. Okay, well, we're going to debit accumulated depreciation for $12,000. I always put my proceeds up at the top, but I guess they're wanting to do it different. Then what are we going to do? Then the cash. Okay, the cash is the amount that they said we sold it for, $25,300. Okay, and then we got to get rid of the truck. How much is left in the truck? 38,400. Remember, that's the used truck. In fact, I'll put used and new. That's why you really wouldn't want to put those in the same account, but there you have it. All right, so down it goes. Now we need to figure out 38,400. So we need to see, all right, this is 37,400. So I really think we need the delivery truck here. Let's put the delivery truck here. We were trying to see if we need a gain or a loss. Okay, a gain or a loss. So turns out that this is 37,300. 37,000 is smaller. So this is going to be a loss. Okay, so we need this number to be exactly what we need it to be for the loss. Okay, so one more time, let's show this. So 12,000 is going down. This is for the sale. Okay, on April 30th. Golly. All right, so April 30th. And this is year two. Sale. Okay. All right, so there that one goes. Here comes the cash. Okay, so we're going to borrow this. Copy. Okay, we're going to borrow this. How much came in? 25,300. Yep. Okay, then we've got to get rid of the truck. So here we go. In fact, I'll just put this beside it. So let's get rid of the truck. It's gone. And then the last is a loss on the sale of the asset. And a loss is always a debit. So if you take, and I can tell you what it is, it's the plug amount. What makes this true, right? Well, how much is it? So if you take the proceed or the amount of the truck and subtract the accumulated depreciation and the cash. Okay, so I'm going to do this. Here's the amount of the truck. Or actually, you would take the truck minus its accumulated depreciation. Okay, and minus the proceeds. Minus the proceeds. What do you get? You get $1,100. This is the amount that it takes to go here in this entry. And we needed a debit here to make this balance. Okay, now that truck is gone. Okay, we don't have to worry about that one anymore, but we've got this one. So now it's time to do depreciation. Well, it's going to be depreciation expense and accumulated, but we're going to have a new one. Okay, a new one. So this is the old one. I'm just going to make me some more room here. Okay, so now we need a little more room for another truck to calculate its depreciation. Okay, so this next truck was $44,100. Now we're on December 31st. December 31st, it has an estimated life of 7,900. So this is truck number 2. Okay, and it's supposed to last 7 years. Okay, residual value on year 2. Okay, for this new truck. So year 2. Very good. Now we've got to come up with 7 years. All right, so the useful life was 8, now it's 7. Okay, so what is 1 divided by 7? Something crazy. Now we're going to take that times 2. Right, times 2. And we get a new rate equals this times 100. Okay, so now let's change that to a percentage. Take out the 100. So we're going to change this to a percentage now. Yep. 29. I don't know. What does it say? It says, do not round intermediate calculations. Round your final answers to the nearest cent. All right. So let me see how far out to take it. All right. So now we're going to take that times 2. Okay. So this is equals this number times 2. Okay. That's going to be the double declining. Okay. Times 2. All right. Wow. Okay. 57% estimated useful life. Okay, we're trying to get to the depreciation of the first year. All right, so depreciation for the first year is the value is 44,100 times 57%. Okay, so it looks like it's 25,200. I'm hoping it's right. If not, we might have to go back. Let's see what we get. We'll pray. Doesn't like it. Okay, hang on. So let me go with let's go with 4 numbers. Okay, 4 numbers, and then let's go to the rate is 4 numbers. Okay. Equals. And we want that to equal that. Okay, so then we want that to go out. And then this annual depreciation. Okay, I know this is going to be tough. Okay, so it's not 25,200 for December for the whole year. Okay, 1 over 7. So one more time, 1 over 7. 1 over 7. We're going to do it this way. Okay, we're going to leave it in, so this is 1 over 7. So this becomes 2 over 7. Okay, so straight line becomes 2 over 7. Let's try this. 2 over 7. Sometimes this rounding stuff is hard to take. Okay, so let's just leave it 1 over 7. I had to do this before in a problem because Excel just takes it too far. So we're going with 1 over 7 as its straight line rate becomes 2 over 7. Now let's take the double declining rate as 1 over 7 times 2, which becomes 2 over 7. Not percent, but the double declining rate. 2 over 7. 2 divided by 7. Let's see what we get. So now we can't. All right, so here's what we're going to do. Times 2 divided by 7. 2 divided by 7. Okay, we got $12,600. Let me see what happens here. $12,600. Might have to use a fraction because it just gets, I wish they wouldn't choose. Hey, we got it. Good. Ugh. All right, so we have to be careful. The first year is 2 over 7, and then this is going to be 2 over 7 again, but not percent. Okay, so, all right, so we're going to put that in. $12,600. Now we need to put that in our accumulated depreciation because that is gone. So the first year of the new is 12,600. Okay, against this 44,100. Now it's year 3. Year 3, September 1, is purchasing another new truck for 89,000 paying cash. Okay. So here comes, and this is coming in on December 1st or September 1st. You have to be careful. September 1st of the 3rd year. It's another new truck. And it's 89,000 and we paid cash for it. So cash is going out for that one. And this is 09 of 01 of 03. There we go. So let's buy this new truck on September 1st, 89,000. And then cash. And then I think we're selling the next truck. So we got 2 trucks. We've got an older truck and a newer truck. Okay, so let's put in that truck. Now, September 4th. Okay, sold the truck purchased on January 9th, year 2 for $26,800. Record depreciation to date for year 3 for the truck. All right, so we've got to do back up here for the double declining balance of that truck. And then we got to do just to the September of that year. So we got to update its depreciation before we can sell it. Let's update it. It's up here somewhere. So here's the next year. If you take the book value times 2 over 7 gives you 9,000. Now we want to take it times 9 over 12 because it was for 9 months. Yep. Not the full annual amount. So I got 6750. So we want to update accumulated depreciation for 6750 and record it in depreciation expense. All right, so let's go ahead and do that. So we're going to update depreciation expense 6750 and update accumulated depreciation for 6750. Let's see if we got that right. And oh no. Okay, hang on. Hang on. Let's go see what's going on here. Okay, got too excited. So that is that. And then this is happening on September 4th. So we actually, it's 8 years, eight months. My fault, 8 months. So it's through August. Sorry, 8 months. So the amount will be of depreciation, $6,000. Okay, so let me put $6,000, and then we'll need to put that in for depreciation to accumulate. Okay, so instead of it's 6,000. Okay, so how much is in here now after? Okay, so we want to sell this against this $44,100. Okay, so now there is $18,600 in accumulated depreciation. So we're going to sell it. So the first thing we're going to do is get rid of depreciation. $18,600. How much cash did we get? We got, for selling the truck, $26,800. So $26,800, and this is on 9/4/04. Okay, so we got, and this is a sale. So it sounds like we get rid of a truck pretty much as soon as we buy a new one. Okay, so that is going to be the cash, 26,800. Okay, so I'm going to start putting this in now. So accumulated depreciation, when you sell a vehicle, you've got to get rid of it. Okay, I'm going to put cash in first, which is what I wanted to do the last time, but they didn't like it. 26,800. Then we are going to put accumulated depreciation and get rid of what's there. Those are the two debits. Okay, so this is for that sale. So I can copy that and put it next to this amount. Okay, now we're ready to get rid of the delivery truck. Okay, so we'll copy this and make that delivery truck go out of here. Remember, it's $44,100. That's why we don't ever mess with the cost. We want the cost to stay intact. Okay, so the delivery truck is gone. And then we needed to put the accumulated depreciation. And now we need a plug. We need a plug. Well, we've got $44,100. The plug is going to be here. It's going to be a gain. All right, how do you know? You just have to do the math. Okay, so the gain is the amount of the truck minus the amount of accumulation minus the amount of the cash. That was all right. And then the gain. So the gain is actually $1,300. Okay, so if you add $1,300, so these two are more than this. So we need $1,300 here as a gain. Okay, so $1,300. Let's see if we're right. Cheebany Christmas. Okay, this last one. My gosh, now it's time to do double declining on the $89,000 truck. All right, we probably won't show that. All right, so let's go ahead and put this in and figure out. All right, so $89,000 is the third truck. And does it have a residual value? Yes, 16,000, and it's estimated to last us for 10 years. So let's put 10. Well, 10 is much better. 1 divided by 10 is what your straight line rate is. So luckily that's 10%. That makes it easier. Okay, so 1 divided by 10 is 10%. So then the straight line rate is 2/10, or 2 times 10. 2 over 10 is okay. 2 divided, let's just put 20%. So straight line rate equals the double straight line rate is the straight line rate times 2. Okay, so there it is. We'll change that to a decimal. I'm sorry, to a percentage. All right, so now we're at 20%. One more time, the straight line rate is 10%. Times 2 is 20%. I'm going to equal what is up here. Okay, so 20% after the first year. Now, be careful. We put this piece of equipment into, right, September 1st. So we're only going to get to show 4 months worth on that first year. So let me fix this. Okay, 4 months of the first year. And I'm going to put that in here. 4 months of first year. All right, so we're going to take that times, be careful, times 4 divided by 12. 4 months out of 12. Okay, and now we can put that in here, and I think we'll be done. My goodness. All right, equals this annual depreciation times 4 divided by 12 is 908. I don't know. Okay. Equals this divided by 12. No, yeah, divided by 12. We'll put this in parentheses. Be careful. Let's divide it by 12 and then take it times 4 months. And maybe it is right. Nope. There it is. There it is. So it's 84.76. Because that's annually. And then we'll divide it by 12 to get it monthly. All right. So then if you wanted to take it monthly, let me see if I could do this again now. Okay, equals the annual depreciation times 4 divided by 12. There it is, 84.76. That's going to be depreciation expense, the final one. And we're down to 1 truck. Yeah, depreciation expense, accumulated depreciation. So we've had 3 trucks. We've sold 2, 1 for a loss and 1 for a gain. Hang on. Let me see what's happening here. Okay, let me check my math for the annual depreciation. Just a minute. It's an $89,000 asset. Oh, here it is. We're going to take this times 20%. Yeah, this times this. Whoop, that. There it is, 17,800. Now we're ready. Now we're going to take this number times 4 divided by 12, and we get 59.33. There we go. I think that's right. 59.33. I'm sorry. I know this takes a while. 59.33. Hopefully. 59.33. Let me check this again. All right, let's see here. Annual depreciation, 20%, because straight line was 10%. So 20% of 89,000, that is for the whole year. And we put this in, we put this in on our books or into service on September, October, November, December. Okay, so now it's 4 months. All right, so let's try this again. So then let's divide it by 12 months. Divide by 12. And then we're going to take it times 4. See if we get the same amount. Times 4. Is that right? 5933. That's what I got. Let me see what they say. Residual life, useful life 10 years, 89,000. Okay, let me look. Okay, this one was extremely, I've never had to put cents in, hardly ever. And oh my goodness, in Cengage. So when I recorded the cents, here we go, right? So one more time, I had the truck, the third truck we bought was 89,000. We bought it in September. At the 1st of September, that means we had 4 months of depreciation for the first year. The double declining rate is 20%. So there is how much the depreciation would have been if we would have done it for a full year. Then we take the annual depreciation divided by 12 times 4, and we get 5933. And then we have to look at the cents. Okay, the cents. Let me put the cents on here. I was missing the cents. There it is. Okay, so yep, we can only go to 2 decimal points. So I was missing the 33 freaking cents. Sorry about that. Yes, accounting can be maddening. That's it. Thankful. All right, so I'm saving my Excel spreadsheet and I'm going to say goodbye for now. So let me go back to Zoom and stop the share. And so, somebody say something. Still here. Oh, okay. Okay. Well, that was way back then. All right. Glad you made it. Let me end this.